Okay, guys, this is chapter 16. This is accounting for accounts receivable, and in a lot of big corporations, especially, even at CDKC, we have an accounts receivable person and that's all they deal with is accounts receivable and collecting on accounts that have been loaned out money. So, in CDKC's instance, it's Rhoda. But we're basically just doing accounting for the accounts, no cash this time. We're just focusing on our accounts receivable. So we're going to be collecting on accounts. Learning objective 1, we're going to apply the allowance method of accounting for uncollectible accounts. So for sales on account, that's our accounts receivable, we're offering customers the ability to pay on account. And what this does is it increases our sales. Because if we only had to deal with cash, then less people would buy from us. If we don't offer sales on account, then our cash sales are fewer. Some customers don't pay back is the problem. So it's a risk you're willing to take, hoping that your customers pay back the credit that you give them. And if they don't, then it's considered an expense, and we have to write it off. So 2 methods for writing it off is the allowance method and the direct write-off method. The allowance method is the method that recognizes the bad debt expense in the same period that it's related to credit sales. So if the bad debt expense, we found out that so-and-so didn't pay their credit off, then we go back and we take it out of the same period in which they bought the merchandise. The first step is to estimate the amount of uncollectible accounts. And then the next step is we make an adjusting entry to our accounts receivable, and then subsequently specific uncollectible accounts are identified and written off. So we go find their personal accounts receivable in their accounts receivable journal and a ledger, and then we write them off. So the next thing we're going to do is apply the percentage of sales and percentage of receivables method of estimating uncollectible accounts. This is just estimating. At the beginning of the year, we're going to estimate exactly how much sales we're going to have, and then of those sales, we're going to estimate how much of it will be uncollectible. So we have the percentage of sales method, so based on the relationship between the amount of credit sales and the amount of uncollectible accounts. So they'll go back through the past years and see how much of their sales have been uncollectible, and they can assume then and estimate what their uncollectible accounts might be for the next year. And then we have the percentage of receivables method, and then this is just based on the relationship between the amount of accounts receivable and the amount of uncollected accounts. So there's 2 ways to do it. You can base it off the entire sales of the year. You can see how much were uncollectible out of all the sales, or you can just see how much trends out of the uncollectible accounts just from the accounts receivables. So the percentage of sales method, the first thing we have to do is determine the percent of credit sales expected to be uncollectible. And this is done by looking at companies' prior year's records, industry averages, or some percentages of similar companies if you don't have any data on your own business. So here's the example. Chris Company has total credit sales of $200,000, and 2,000 of those credit sales had been uncollectible. So basically, we look to see what percentage of our sales are uncollectible, and we take that 2,000 uncollectible accounts divided by 200,000 credit sales, and we find out that 1%, in your calculator it'll say 0.01, 1% of those $200,000 worth of sales were uncollectible. So then we can use this for future periods to estimate the uncollectible accounts. So next year, if we have $500,000 worth of sales, we can assume that 1% of those would be uncollectible, which would be 5,000. So during the next year, Chris Company has credit sales of 120,000. What amount should be recorded as bad debt expense for this year? And they have to record it prior. So we're just going to estimate, and we're going to estimate that it's going to be the same, about 1%. So we take that $120,000 credit sales, multiply it by 1%, and we're going to estimate that $1,200 of those credit sales will be uncollectible. So here's our general journal. This is how we do the adjusting entry. So on December 31st, we're going to record our bad debt expense. We're going to assume that at the end of the year, $1,200 are going to be uncollectible. So we debit our bad debt expense, $1,200, and we have our allowance for bad debts. This is the new account, and it's going to be credited $1,200. The income statement is going to show revenue sales of $120 and bad debt expense of $1,200. So this is going to be the percentage of sales method. Subsequent write-offs. So let's look at how write-offs are recorded under the allowance method. Under the allowance method, the write-offs affect the balance sheet only. So the allowance account, accounts receivable, and the subsidiary ledger account are all reduced. And that's just the subsidiary ledger, remember, is the specific name of the person that has the accounts receivable. So in this case, we're going to debit our bad debt, allowance for bad debt for $1,100. And this is just assuming that the next year, we're assuming that this is going to be our, actually, I think we're writing off. Yeah, we're writing it off. So we're writing off $1,100 for so-and-so. And we're going to then debit our allowance for bad debts and then credit our accounts receivable / whoever it is that we're writing off directly. So now that amount becomes zero in both. So the bad debt expense account is not affected. The expense for this uncollectible account was recognized in the adjusting entry that we did prior. So this is the percentage of receivables method, which happens to be the most simple method. Basically, we apply an estimated percentage of uncollectible accounts to the accounts receivable balance to determine how much estimated uncollectible accounts from our accounts receivables. So here's the example. Kraft Company has average accounts receivable balance at the end of the past 2 years of $110,000. They just took the balance of their last year's accounts receivable, added them together, divided by 2 to get their average. And they have an average uncollectible account in the last 2 years of $4,400. So they're going to take their average uncollectibles, divide it by their average accounts receivable to get 4%. And this is going to be used in future periods to estimate how much will be uncollectible. Kind of the same idea, just using specific accounts receivable numbers instead of sales numbers. So at the end of the current year, using that same example, accounts receivable balance was $120,000. So we're just going to use the standard 4% that they assume is kind of annual for them. What amount should be recorded as bad debt expense? We're going to take that number, multiply it by 4% to get 4% of $120,000, which is going to be $4,800, and they're going to assume that $4,800 are going to be uncollectible that year. And hopefully that's not the case, but they're going to prepare for it. So the adjusting entry for December 31st would be this. The bad debt expense would be debited for $4,800, and allowance for bad debts is going to be credited for $4,800. And we're assuming the allowance account has a zero balance prior to the adjustment. So aging receivables, and aging schedule is prepared which details each customer's account balance and how long it's been outstanding. This is just an aging schedule is just for the people who have past due accounts. And then basically we just try to keep track of how old they are and how long they've had a withstanding balance. Estimated percentage uncollectible is based on the age of the account. So the older the account has been uncollected, then the less likely it is going to be collected on. If it's 30 days past due, there's still a pretty good chance it's going to be collected on. If it's 4 years past due, there's a pretty good chance that it's not going to be collected on. So this computes a more precise estimate of uncollectible accounts. So here's what, and this is in your books as well, so you might want to look in here because it's going to be a chunked up slide-by-slide version. This is the first part. You have the customer name, the total that they owe, and then a column that says that's not due yet. So whatever services have not been quite to the 30 days yet. So you see W. Billard up there. He owes a total of $3,000, but $2,500 of that was just billed. So $2,500 isn't due yet. K. Campbell right there, he owes $950, and all of that has been due at some point. So you can go look through the rest of those. Customers and balances are listed. And this is the next slide over. It would go straight across from the slide previous. You can see what each customer owes in each category. So that first customer has $500 that is in the 1 to 30 day bracket, 31 to 60 days, 61 to 90 days past due, 91 to 180 days past due, and then the longer it goes past due without being paid, the more unlikely it is to be paid upon. So then you have each category totaled, and you can tell the amount of total accounts receivables and the amount that's not quite due yet. And you can also tell the amounts that are 60 days, 100 days, whatever past due. And then you take that not due yet amount and multiply it by your estimated percent of uncollectibles. In the last example, it was 4%. In this case, it's 2%. And they're going to assume that of that $65,000 that's not due yet, they're going to have $1,300 of it that is uncollectible. So the percentage of uncollectible accounts increases as the accounts become older. So you can see if it's over 365 days past due, there's an 80% chance that it's going to be uncollected. We total all the other accounts to see how much is owed where. And here's the adjusting entry. In this case, it's the same one. Bad debt expense is debited and allowance for bad debts is credited for the amount that we assume will be uncollected. And then during the year, accounts totaling $5,200 were written off. So in that case, we go and debit our allowance for bad debts, $5,200, and then we go and find each individual person and credit the accounts receivable and each individual person's names that were written off that year. So here's the T account for what that would look like after write-offs. The allowance account is left with $300 credit balance. So we had $5,500 that we gave ourselves for an allowance for bad debts. We actually had to write off $5,200 of them, so that we actually did pretty good because we were left with $300 more than we assumed that $300 would not be collected upon. So we actually ended up good there. So at the end of 2002, another aging schedule is prepared, or the next year, another aging schedule is prepared, and it shows the estimated uncollectible accounts of $5,700 this time. So this time goes around and we have another $5,700 that we need to have in the allowance for bad debts. But instead of $5,700 right now we have $300, so we have to do some adjusting. We need an adjustment of $5,400. And then that $5,400 adjustment is going to leave a $5,700 balance in there, as you can see. So here's just a little slide comparing the two methods. So you have percentage of sales and percentage of receivables. Depending on what kind of business you have and what works better for you, you can use either one of them. It just explains the two kind of like we did already. Just how they do things different. So the effect of write-offs on your financial statements. I'm going to try to move this down a little bit. So the effect of write-offs on your financial statements. On the income statement, there's no effect. The expense was already recognized during the adjusting entry, so it'll show up on your worksheet, and it won't affect the income statement at all. Also on the balance sheet, there's no effect overall because all these adjustments are made before you do your financial statements. So here's an example of a recovery from a previously written off account. So sometimes miraculously, when these entries are written off, randomly, someone will pay them. A check for $500 was received on February 1st from Bill McDonald, whose account was previously written off on January 15th. So we wrote off his account on the 15th of January, thinking we're never going to get paid. And then, lo and behold, February 1st, this Bill McDonald pays us. So this requires two entries. We got to reinstate him back into, so we have to debit his accounts receivable / B McDonald, and then credit his allowance for bad debts. We have to put him back into the system, and then we would pay him off just like he had paid it on time. So we debit our cash because we got $500 cash from him, and then we credit that same account that we reinstated him in, the accounts receivable / B McDonald. Learning Objective 3, we're going to apply the direct write-off method for accounting for uncollectible accounts. So the direct write-off method is a bad debt expense is not recognized until it has been determined that account is uncollectible. So we don't, basically with the direct write-off method, we don't assume there's going to be uncollected accounts. So we don't forecast any uncollectible sales. The advantage is it's really simple. Disadvantage is it violates the matching principle. The amount of the expense can be manipulated, and the balance sheet does not reflect the amounts of actual accounts receivable expected to be received. It just says the entire amount. So J. LaFolette's account is written off under the direct write-off method, and basically all we do is we just write them off. You debit your bad debt expense and credit your accounts receivable / J. LaFolette. So they're gone. If he pays the $500 in the same accounting period, two entries are needed. You basically reinstate him, put the money back where it came from, so put it back into the accounts receivable and take it out of the bad debt expense, and then you pay him off. So the cash was received for $500, and the accounts receivable is then credited. Now, if the entry was paid off, but it was in a different accounting period, it's done a little bit differently. So we had written this guy off, this J. LaFolette, and had debited his bad debt expense, credited the accounts receivable. Now, if he paid it off within the same within a different accounting period, we still debit the accounts receivable / J. LaFolette, but then we have to put it in an uncollectible accounts recovered account. If it's in a different accounting period, we use the uncollectible accounts recovered for that credit. And then we pay it off. So we debit the cash, credit the accounts receivable, just like we would if he paid it on time. And that's the end. Homework is posted on Moodle, and homework is non-existent this chapter, but this chapter will be incorporated into your midterm. So have a good week, guys.